Why one assets move rapidly when there are no major data publications concerning those asset classes? Well, today we are going to answer that question, which means we are going to talk about correlation on the markets between asset classes. So let's dive in straight into the topic. First, of course, we need to discuss what is correlation itself. So basically, it is a ratio which shows us how much those two assets move in sync. They can move in sync in positive way and negative way, which means the correlation can be positive and negative, which means if, for example, one asset is rising, the other asset that is correlated highly with this asset is falling. And the positive, of course, is when one asset is rising, the other one is rising as well. So yeah, that's basically how we are defining correlation. And if you Google, for example, the correlation calculator, this might show up, and we can check how it looks to, of course, discuss, because we are not talking about any correlation. There are some more significant and we could say less significant or basically not important correlation. So here we have I choosing gold correlation between to check the correlation between gold and government bonds. So let's view the correlation and see the chart. So basically this chart shows us how those two asset classes correlate between each other. So as you can see, only 2 times, there was somewhat a significant correlation between gold and the government bonds, positive correlation, which means they move somewhat in sync. Because we are only considering the correlation when the ratio shows us 0.8 or minus 0.8, because this scale can go from -1 to 1. And we are only considering the correlation that is viable, that is significant, when the ratio is at least 0.8. But sometimes when the correlation is showing us values like this, 0.75, we can count on that as well. But right now, as you can see, the correlation is almost 0, is 0.3, so that is for us statistically not significant if we compare those two assets. So if we know that, now let's move on to some charts, and discuss what are the couple correlations that are most popular and most important on the markets. And so let's begin with the correlation between the price of oil and the price of Canadian dollar currency. And so if we talk about why, we need to know, of course, that the oil is one of the main products for export for the Canadian economy. And so, of course, the main buyer are the US. They buy almost all of the oil from the Canada, around 90%. So yeah, of course, the oil is quoted in US dollars, and then all the exchange of the payment is in US dollars. But yeah, after that, when they convert the currency, it might influence the quotes. That is in a very brief shortcut. We will not dive into too deep because it would require a whole nother video. So if we check the chart, the correlation was the correlation between the price of oil and Canadian dollar was positive, which means that if we analyze the currency pair like USD CAD, that means the correlation is negative, because the CAD then is the second, here for you will be the second currency in the order, which means basically that when the price of the USD CAD is falling, then the Canadian dollar is getting stronger. So if we check the chart, it shows us the price of oil, which is this one, and the price of USD CAD. And as you can see, the correlation is, as I told you, negative, which means when the price of USD CAD is going up, the price of oil is going down. So basically, when the price of oil is going up, the price of USD CAD is going down, because CAD as a second currency in the currency pair is getting stronger. But this correlation recently slightly deviated. As you can see, up until now it was very, very clear. Right now it's slightly lower, but what I have on mean is, of course, when we have data like crude oil inventories or the OPEC meetings, everything that concerns and might influence the price of oil, the supply of oil, it will influence the quotes of the USD CAD currency pair and all other currency pairs that includes Canadian dollar. So yeah, that's the first one, very important. So after a situation like you have on the chart USD, you have the USD CAD, you're trying to trade it. And for example, there are no major publications from the Bank of Canada, but suddenly the pair starts to grow or rise rapidly, then most likely something happened on oil. Okay, that said, let's switch to the second one, which is gold. So if we add to the chart the dollar index, which is DXY, you will see that gold has inverted correlation with the US dollar. DXY is a dollar index, is a basket which measures the strength of the US dollar against 7 other currencies. So basically, it more or less represents the overall strength, global strength of the US dollar compared to other currencies, other nations' currencies. So as you can see, it has the opposite correlation. If the dollar rises in value, the gold falls in value, so on and so forth. Only right now, this correlation slightly deviates, because right now we have more or less a stable value of the US dollar, but the gold is rising. So yeah, guys, that would be all for this video. I covered only 2, but I think one of the most important correlations on the market. And yeah, I hope you find it interesting and will try to check as well which other assets correlate with each other and how you can use those correlations in future in your trading plan. So yeah, thank you for watching and till next one.